Hey warriors, I hope you're all doing great. This is your friend CA Rahul Agarwal and I'm here to discuss something very important with all of you. This is for all of my friends who are appearing for the Jan 2026 CA Inter examinations. Your RTPs are released and we are here to discuss that. Now, I know this RTP was released a couple of weeks ago, but I was purposely waiting on this video. I am shooting this video before even your results have come in for September 25, but I'm hosting this only after the results are out because I know this paper is equally relevant for those of my friends who have unfortunately not been able to clear your September exams. I know it must be a difficult battle for you right now, but trust me, sometimes it is required. Sometimes it's all that is required for you to know where you are missing out, and sometimes you need to understand that things are not given to you for granted. So nevertheless, I know it's going to be a difficult phase, but this is the time for you to step up your game and come back stronger to come and say everyone that maybe September was not my thing, but January is going to be my last attempt. Yes, so with that understanding is what I'm making this video. So for all of my friends who could not get through September, please take some time out for yourself, recover, but please start back stronger. Take off whatever is pending in your previous attempts which you could not go through and do it properly for your upcoming Jan exams. I know we just have a very small short period of 60 days left in our hand for your exams to come up, but trust me, if you put the right efforts and if you understand what you have been lacking out, 60 days is way more than sufficient to not just score a pass but to also score an exemption. Yes, so my only request to all of you is don't restart the whole process, only try to do better than what you have done last time. With that understanding, people, I am going to go through the RTP of the CA Inter paper number 3A income tax, which has been released for Jan 2026. We're going to read the RTP and see what and all interesting things that ICA has given in this paper and whether you should be focusing on this RTP for your exams or is this something which you can only use as a practice. Yes, let's go. With that, people, when we do an RTP analysis, always an RTP comes up with some things called MCQs. So I'm going to first look at the MCQs and then we're going to see if the MCQs are going to be critical enough. If I'm going to do this from an exam standpoint, I am never going to read the story first, but I'm rather going to be focusing on the questions and then preparing the story accordingly. So let's look at the questions and then we come back on this. Yes, questions are as follows. The questions come and say that I have to compute the income under the head income from house property of a person called Mr. Vivek. So there is a person called Mr. Vivek who's going to be having any income from house property. I need to find and understand what is his income from house property. Good enough. Question number 2. What is the income under the head capital gains for the same person called Mr. Vivek? So they want to know what is a CG also. Let's figure that out. Point number 3. What is the amount of tax credit will be available to Mr. Vivek for 24-25 if tax has been deducted by the deductor? So some TDS has been happening on Mr. Vivek. We need to understand that rules also. Point number 4. In 2033-34, oh, that year, okay, Mr. Vivek has received the maturity proceeds from both the policies of 40 lakhs and the policy of 27 lakhs. Considering the most beneficial option, which of the following statement is correct? People, the LIC policies which I've been discussing with you, that I've told you that when it comes to life insurance policies, nothing can be taxable in the current year, but expect MCQ questions on this. They've given you an MCQ question. So we are figuring out that. Next, compute the tax liability of Mr. Vivek for the assessment year 25-26. So they want the tax liability also. That is what the fact patterns are. Yes, so we're going to look at all the questions and let's see what is the right answer. Every data is from Vivek's perspective, so I'm going to focus on Vivek and let's see what the right questions have come in. First, I have a person called Mr. Vivek Manotra, is an Indian resident. Okay, so they've confirmed that the person is a resident, helps me for my tax liability. The person has 4 residential house properties in India. Okay. 2 of them residential house properties are in Delhi and they are self-occupied. So I have 2 SOP properties. One is a let out property for a monthly rent of 1,40,000 to Mr. Sushil, a salaried individual. The other 2 properties are in Mumbai. One second, something is wrong. Oh, okay. So the question says one of them is self-occupied, the second is let out. Okay. So in the Mumbai property, in the Delhi property, I have 1 SOP and I have 1 LOP. The other 2 properties are in Mumbai. To reduce his tax liability, he has gifted one of the residential house properties in Mumbai to his wife, Mrs. Anika, and second one to his minor daughter, Mrs. Pooja, without adequate consideration in the month of April 2024. So now what has happened, people, is that I have a property. I have technically 4 properties. In that 4 properties, one of the properties I've treated as SOP, one has gone LOP. No problems there. Second, balance 2 properties which I have. One of the property I've given off to my wife and the other property I've given off to my minor child. Yes, people, here is where deemed ownership rules will come into picture. Deemed ownership rules basically come and say that if you give any property to your spouse or to your son's wife, or to your son's wife, then in that case it will be deemed as I am the owner of the property. At the same time, if I'm going to give this property to my minor child, then also it is deemed ownership in my hand. That is what the rules come and say. Please note carefully that here clubbing rules will not apply, but rather deemed ownership rules will apply. So keep that in mind. Where are we? Yes, expected monthly rent on the self-occupied property in Delhi is 50,000 rupees and the expected monthly rent of the property in Mumbai is 75,000 rupees each. Okay, he has paid municipal taxes amounting to 1,20,000 for the let out property. So 1,20,000 ke liye he has paid municipal taxes as well. Next, in addition, Vivek has sold a plot of land. Okay, I think with this facts, people, we can already start computing my income from house property. So let's see what is my income from house property. Two things I'm going to keep in mind is that first, I'm going to have something called as an LOP property. Now, in this LOP property, what is the data given to you? The data given to me in the LOP property is I have rent of monthly 1,40,000 rupees. So 1,40,000 is my rent, multiplied with 12 will give me 16,80,000 rupees as my GAV. As my GAV. Nothing is mentioned about anything else like municipal rent, fair rent and all. So I'm assuming this is my GAV. On this, I now have a municipal tax which I can claim. Number is 1,20,000. Yes, so claiming of 1,20,000 in the municipal taxes, amount is going to become 15,60,000. Now, no information about interest on loan, people, so directly flat 30% standard deduction. My taxable income now is 10,92,000. Yes, so this is going to become my income from house property when it comes to my LOP house. I hope this is making sense to everyone. Yes, amazing. Let's read further. Oh, question says, has opted out of default tax regime. Yes, very good. So which means I am going for ATR. That is already a good enough understanding for me. With that, people, I am going to go to my SOP property. Let's look at my SOP property. Now, in my SOP property, what has happened is I have technically one property in my name, one property in the name of Anika, and one property in the name of minor daughter. Yes, people, with the deemed ownership concept coming into picture, I am now technically the owner of all the three houses. With me being the owner of all the three houses, I can decide two houses to be treated as SOP and one has to go for LOP. How do you make the choice? It is your decision. You can decide whatever you want to treat as LOP because at the end of the day, you have to pay the lowest tax. In that understanding, people, I would like to consider one of my Delhi property as SOP and one of my Mumbai property as LOP because Mumbai is going to show an higher GAV case. Yes, the Mumbai property is going to show higher GOP case. So therefore, I'm not going to take them into consideration, which means that leaves me with one more DLOP property, which is the no. Actually, I want to lower my tax, right? So in that case, what will I do is I would like to assume first Mumbai property as SOP, second Mumbai property also as LOP, and my DLOP will become the Delhi property because the Delhi is showing 50,000 rupees in my hand. Yes, so let's keep that in mind. With that understanding, people, my Delhi property becomes fully taxable. So 50,000 into 12 is my taxable income, which is 6 lakh rupees. And on the 6 lakh rupees, I can now claim a 30% standard deduction, which means 1,80,000 will be removed as deduction, giving me a taxable income of 4,20,000. A taxable income of 4,20,000. So with that data, people, I can now find out what is my income from house property. My income from house property should be 15,12,000. Yes, option B is the right answer. Option B is the right answer. This is what the facts is. Yes, I think this was fairly an easy question, people, but yes, you have to keep in mind the deemed ownership concept. Also, one thing to be kept in mind, a lot of students may have made this mistake. I don't know if there is an option of similar terms, but yes, people, there is a mistake which people make. A lot of students come and say, Rahul, when it comes to this minor daughter income is clubbed in your hands, no? So why can't we apply the 1,500 exemption? People, understand 1,500 as an exemption concept is only applicable to you provided you are in clubbing chapter. The deemed ownership concept has no such concept of clubbing, has no such concept of exemption, which means for a minor child income, I am not doing it because of clubbing rules. I'm doing it because of deemed ownership rules, and therefore that will still be taxable in my hand fully. I will not take into consideration the 1,500 worth of exemption. Be very, very careful. Clear? Yes, amazing. So I think the answer should be 15,12,000 people from my options. Let's check if the right answer is there. Yes, 15,12,000 has been given as my right answer. Clear enough? Good. Read further. Question says they wanted to compute his capital gains. I think the second question. Yes. So let's see his capital gains. Question says, in addition, Vivek has sold a plot of land in Bangalore on 19th December 2024, post 23rd July, people, post 23rd July for 49 lakhs, for which he has paid 1% as brokerage on sale consideration. Okay. Stamp duty value of the property is given as 55 lakhs Plot of land was purchased by him for 3 lakhs in 1992. Fair market values of those properties on 2001 is given as 7.2 and 7 lakhs. Vivek has invested 12 lakhs in RECL bonds. People, I remember giving you this complete format of capital gains on immobile property. A very beautiful, easy format which should help you do all your questions. So we're going to follow the same format. Yes, I'm going to start with what is called as full value of consideration. In full value of consideration, we discussed it is stamp duty value or actual consideration, whichever is higher. Look at my actual consideration. My actual consideration is given as 49 lakhs, whereas my stamp duty value is given as 55 lakhs. Always check for 110%. So if I do 49 lakhs plus 110%, answer is 53.9 lakhs, still lesser, and therefore full value of consideration will become 55 lakhs. On this, do I have any transfer expenses? Yes, I have paid 1% as brokerage. So transfer expenses will be taken into consideration. 49 lakhs pay 1%. Answer is 0.49 lakhs. My net consideration is going to become 54.51. 54.51. Clear? Yes, great. Let's move on forward. We're looking at what is called as cost of acquisition. People, this property was purchased before 23rd July. So cost of acquisition will be as it is without any indexation rules. Cost of acquisition is going to be my actual cost versus STV or FMV, whichever is lower, compared and higher. Yes, so let's look at my STV and FMVs. FMV is 7.2, STV is 7, whichever is lower, answer becomes 7. This 7 is going to be compared with my actual cost, which is 3, whichever is higher, therefore the number becomes 3, the number becomes 7. The number becomes 7. So 7 is going to be my cost of acquisition. Nothing is given about my cost of improvement, therefore this number remains as it is. So plus, I get the answer as 47.51. I get the answer as 47.51. My long-term capital gains is going to become 47 lakh and 51,000. Now, this person has invested about 12 lakhs in RECL bonds on 15th July 2025. People, what is my date of transfer? My date of transfer is 19th December. Yes, an income tax rule come and say you can claim an exemption under 54EC only if you have bought the properties within 6 months. Yes, so you should have bought the bonds within a period of 6 months from the date of transfer. 6 months from the date of transfer would become what, people? It will become January, February, March, April, May and June. So you should have bought this bonds within 19th June 2025. You have bought this bond on 15th September, which is a problem. You cannot buy this bond on 15th July. Therefore, this will not be taken into consideration. Your bond value becomes 0. You can't claim those deductions, and therefore my long-term capital gain is going to become 47,51,000. This is the right answer. Option number D. Option number D is the right answer. Yes, good. With this, people, we are moving on forward to the next question. Question was about what tax credit can the person claim if the tax has been deducted by the deductors. Now, here is where you have to be careful. People, so many people will make a mistake here because you do not notice the complete thing. Question was not about deductor, question about deductors. If you notice, this transaction has 2 elements on it. One, you have a rent payment, and second, you have something called as an immobile property. With that facts coming into picture, people, you need to be very, very careful about this thing, that 2 sections are going to be involved. One is called as section 194IB, where section 194IB comes and says when you give your property on rent to someone for more than 50,000 per month, then TDS is applicable on those transactions also at the rate of 2%. Yes, so in this, if you notice, I have a monthly rent of 1,40,000. So 1,40,000 paid 2% would have been applied to you. So 1,40,000 multiplied by 2%, answer is 33,600. Answer is 33,600. This is your TDS number 1. Second, I have TDS number 2, which is coming for my immobile property. Immobile property is 194IA, where the property value is 1% of the sale consideration or stamp duty value, whichever is higher. So I have stamp duty value of 55 lakhs, which is the higher element. 1% of that becomes 55,000. Is it? So it is 5,50,000. 55 lakhs into 1% becomes 55,000. This is my total TDS. Which means answer becomes 88,600. 88,600. This is my TDS. Yes or no? Yes. Let's keep that in mind. So answer is 88,600. Option number A. Option number A. I hope you got this one, people. This one was a little tricky because yes, students may have realized about the sale of the immobile property, but they may have forgotten on the fact of the rental property. Rental property is also liable for 194 IB, so be very careful on that as an adjustment of. Yes, good. Then we move on forward to the last one, which was about your life insurance policies. Let's read the question. The question says he has taken a life insurance policy on 15th May 2023 and a policy B on 1st July 2023 for 10 years with a sum assured of 35 lakhs and 25 lakhs respectively. The premium payables is 3.5 lakhs and 2.5 lakhs. Yes, so this person has now paid a premium of 3.5 lakhs and has paid a premium of 2.5 lakhs. People, IFRS chapter rule comes and says when it comes to life insurance policy, you should not take a policy premium more than 5 lakh rupees. In this case, I have taken a policy premium more than 5 lakh rupees in both the transactions, and therefore I will have to decide on which policy I would like to exempt and which policy I would like to tax. Yes, so with that understanding, people, we'll have to make a choice. Understand, this policy is taken for 10 years, which means over the years, I'm going to make a maturity proceeds. Have the question come and clarified what is my maturity proceeds? Oh, yes, the question is clarified my maturity proceeds here. In the first scenario, I'm going to get a maturity proceed of 40 lakhs. Now, if you notice, 40 lakhs worth of maturity proceeds, I would have paid 35 lakhs. How did Rahul pay 35 lakhs? Because 3.5 lakhs is the total premium value for 1 year and 10 years I'm going to pay. So therefore 35 lakhs I would have paid, in which case I will get a taxable amount of 5 lakh rupees. Or wherever I go to the other case, I'm going to have a policy value of 27 lakhs in my maturity, whereas I'm only going to pay 25 lakhs for it because 2.5 lakhs is what the total premium value is for the 10 years, and therefore it becomes 25 lakhs, which means I'm now going to make a profit of rupees 2 lakhs. By this logic, people, you can itself come and tell me which policy should I exempt. Which policy should I exempt? In this case, I would obviously come and say because the premium is more than 5.5 lakhs, I don't have an option but to tax one of the policies. Which policy I would like to tax? I would like to tax policy 25. Yes, I would like to tax the policy 25 because that is the policy where I'll pay the lowest tax, which means I would like to exempt this policy. I would like to exempt this policy. What policy is that? Policy B, I think, is the one. Yes, policy B is for 25 lakhs. So the answer is policy B should be taxable. Policy A should be exempt. Let's read further. The maturity proceeds from both the policies is exempt. Answer is no. The maturity proceeds from policy A is exempt, but policy B is taxable. Yes, this is the right answer. This is the right answer. Third one says policy B is exempt. No. Maturity proceeds of both the policies is taxable. No, definitely not. Multiple policies, one of them can make an exemption, can become an exemption. So the answer is option B. Yes, with that facts, people, let's see if I have B, D, A and B. That is what the right answer should be. Yes, B, D, A and B. That is what I'm getting as the right answers. Clear? Amazing. With that, people, I am left with the last question. Last question was about computing tax liability. Now, here is where you'll have to be a little careful from an exam perspective. One, people, things are to be kept very carefully in mind. Let me put out the statement, you will understand this better. When I come to your HP, what and all have we agreed upon? In HP, we have agreed upon the fact that in HP, you can claim a deduction. Your taxable income is about going to be 15,12,000. Second, when it comes to capital gains, here is where the whole challenge will start. What is what we will discuss, but nevertheless, answer is 47,51,000. Third, when it comes to IFRS, do I have any IFRS? No, which means my GTI is going to be 47,51,000 plus 15,12,000. Answer is going to be 62,63,000. Answer is going to be 62,63,000. Now, people, at this stage, if you start computing taxes, you are mistaken. Unfortunately, ICAI has very smartly come and talked about the fact that you have taken some life insurance policies. With the fact that you have taken life insurance policies, ICAI has very indirectly come and told that in the current year also you would have paid some life insurance premium, which means you are eligible for 80C. Yes, so you should have kept this in mind and you should have claimed something called as a deduction under section 80C, which is a maximum limit of 1,50,000. Yes, so with that getting reduced, answer becomes 61,13,000. 61,13,000 is what you should have done. This is something to be kept in mind, people. Unfortunate mistake if you have made, then that would have been a problem. That would have been a problem. Be careful on that. Yes, good. With that, people, we can start computing taxes. Now, here is where two problems will come. One is you will have to do this as per old rules, and one is you have to do it as per new rules. Now, what is this old rules and new rules, people? You might have learned that there is an amendment in the current year. The amendment comes and clarifies that because I'm taking my immobile property for new rules without any indexation, I will now be given an option. Because the asset was purchased before 23rd July, I can now decide to tax it as per old rules or tax it as per new rules, whichever is beneficial to me. Whichever is beneficial to me. So I'll have to compute this as per old rules and new rules and check whichever is beneficial to me. Let's see what the right answer is. First, let's compute it as per new rules. We have the data, we can do it easily. Yes. So what is going to happen? I'm going to say in the 15,12,000 of my slab income, I have claimed a deduction of 1,50,000, giving my slab income as 13,62,000. In this 13,62,000, for the first 10 lakh rupees, I am taxable for an amount of 30%. Number is 1,08,600. Adding 1,12,500 for a normal category person. The tax liability on my normal scenario, have they given us age? No, they have not been given as age, which means the normal tax liability slab income is going to be 2,21,100. This is my slab incomes. Let's check 112 also. In my 112, what is going to happen? I'm going to say 47,51,000. On the 47,51,000, 12.5% will be my tax rate, which means answer is going to be 5,93,875. 593,875, taking both into consideration, 221,100. Answer is going to be 8,14,975. 8,14,975. Now at this stage, people, you have to be extremely careful on the fact that the total income is showing 61 lakhs. Because the total income is showing 61 lakhs, you are liable for surcharge. Yes, so let's add a surcharge as well at the rate of 10% on the case, which means adding a 10% surcharge and a 4% cess, my tax liability is going to shoot at 9,32,331, which I'm rounding off to 9,32,330. Yes, good. With that, people, I will now have to compute something as per old rules. Now, before I compute old rules, we need to recompute my CG. Yes, so first, let's recompute my CG and see what the right answer is. And compute what my right answer is. My full value of consideration in this case is still going to be 55 lakhs. My transfer expenses is going to remain at 0.49. My full value of consideration, net consideration, is 54.51. With my cost of acquisition given as 7, I will now try to compute what is my new cost of index. So 7 into 363 divided by 100 will give me 25.41. Giving me my net income as 29.1. So my capital gains is now going to become 29,10,000. Let's keep that in mind. So what is going to happen? My HP income is going to become 15,12,000. My long-term capital gain is going to become 29,10,000, giving me my total income of 44,22,000. Yes, on this 44,20,000, I will reduce 1,50,000. Answer is going to become 42,72,000. I hope this part is clear to everyone. I hope this part is clear to everyone. Yes. So what have I done, people? I've simply gone and computed my indexed cost of acquisition for my property, which I've transferred off, because I'm eligible for new rules and old rules, whichever is better to me. With that, people, let's start computing taxes. My 15,12,000 is not going to change, which means my 15,12,000 tax remains the same, which is 2,21,100. So my slab remains as is. My slab remains as is. Coming to my LTCG. What am I going to do, people? I'm going to start taxing it at the rate of 20%. So what is going to happen? I'm going to take 29,10,000 multiplied with 20%. Answer is 5,82,000. Answer is 5,82,000. With my income being 5,82,000 and 2,21,100 adding to it, answer is going to be 8,03,100. 8,03,100. That is what it is. Yes, have the question. Yes. 8,03,100. Now, people, can I apply a surcharge on this case? No, because if I check as per my old rules, my income is only 42 lakhs, which is less than a surcharge limit. So I take the number as it is and I add 4%. It says answer is directly 8,35,220 here. 8,35,220 here is what the right answer is. So I should get that answer as 8,35,220. Amazing. I have it in option number D. I have it in option number D, 835, 220. So this is what the right computation will look like. Yes, so this is how the computation has been done by ICAI for you to get your right answer. This was complicated, people. Definitely for 2 marks, definitely does not make sense. I hope this does not come in your exam, because it will take a lot of time and patience for you to complete this off. But yes, a good question for you to practice, because a lot of places they had silent adjustments which could have really impacted your understanding. Yes, so let's keep that in mind and let's do this properly for your exam purposes. I hope you were able to get the same answer, people. If not, yes, make some proper notes for your examination. Go to the relevant chapters and note down that yes, this is the mistake I made, this is the mistake I made, and I need to claim those properly. Clear enough? Great. With that, people, we are moving on to your next set of questions. Let's look at all the descriptive ones. Question says, I have Mrs. Anchal, an Indian citizen, government employee working for the Indian government. Okay, government employee claiming deductions. She submits the following information given to you for the previous year ended 31st March 2025. Before I look forward, let's look at what the conditions are. Determine the gross total income of Anchal for the assessment year 25-26, assuming that she has opted out of the provisions of 115 BAC, going for old regime, on the assumption that she is a resident but not ordinary resident, and if she is a non-resident, which means the question wants you to find out what happens if she is an RNOR and what happens if she is an NR. That is what the question says. By the way, the question wants you to find what gross total income. It does not want you to find the total income, people. Only GTI has to be checked upon. Yes, so let's check. It says salary income is received in Malaysia for services rendered there. I am receiving salary in Malaysia for services being rendered there. People, here is where you will end up making mistakes. Understand, when it comes to income tax says if you are a government employee, an Indian citizen working outside India, salary is being paid by the government, it is fully taxable in India. Which means it is deemed to accrue or arise in India. So this income will be taxable regardless of whether you are an RNOR or you are an ROR. I'm sorry, whether you are an NR. Yes, because it's a salary income which is received in Malaysia given by Indian government. So an Indian government giving a salary to a citizen of India will be fully deemed to accrue or arise in India. Second, profits from business carried on in Chennai. The moment I see the word Chennai, it is always taxable, because it is deemed to accrue or arise in India. Third, loss from business carried on in Vadodara. People, Vadodara is also in India, which means loss can be claimed as a set off. Finally, loss from a business carried on in USA, though profits are not received in India, business is controlled from Rishikesh. People, business is controlled from Rishikesh. The moment your income is coming from a business controlled from India or profession which is set up in India, RNOR will say fully taxable. Yes, because RNOR is saying fully taxable, RNOR can claim this full losses. NR will say ignore it off. NR has nothing to do with this computation. Yes, good. Unabsorbed depreciation of the business in USA, nothing to do with India. Or can I come and say for an RNOR, this is also allowed? Because whether you call it a business or you call it UD, at the end of the day, it is part of my computation. If the USA profits and business are going to be taken from a controllership in India, I may come and say that the 16,000 is still part of the computation sheet, and therefore this also should be claimed as a deduction. Next, profits from a business in Bali, which is controlled from Delhi, and 60% of the profit is deposited in a bank in Bali, 40% is received in India. Yes, so which means again controllership has come into picture. So for an RNOR, this is going to become fully taxable, whereas for an NR, I will only tax the 40% of the number. So 70,000 into 40% should be the right answer. Answer is going to be 28,000. Next, rent from a house property which is situated in USA and received in USA. Nothing to do with both the facts. Nothing is going to be taxable. Yes, I think this should be the right answer, people. Let's see the right answers. So what am I going to have? I'm going to have, yes, all facts are with me. So which is going to be 2 lakhs plus 80,000 minus 20,000 minus 46,000 minus 16,000 plus 70,000. Answer is going to be 2,68,000. Yes, 2,68,000. Let's check for the other party. For the other party, what am I going to do? I'm going to say my profit is 2 lakhs plus 80,000 minus 20,000 plus 28,000. Answer should be 2,88,000. Answer is going to be 2,88,000. This should be the right answer. Yes, let's check. Something is wrong. Ah, that's an interesting thing. People, okay, my mistake. As much as I keep telling this in exam, I have myself missed it off. Yes, the words used to salary received. The words used to salary received. The moment you start using the word salary received, it means that you are eligible for standard deduction. You're eligible for standard deduction, where the question says the person is opting out, which means I'm eligible for a standard deduction of 50,000 in both the scenarios. Yes, so let's reduce the 50,000 standard deduction. My mistake, people. Yes, my mistake of 50,000 standard deduction. 2,18,000. Here it is 2,38,000. Yes, so this is also eligible for a standard deduction. Let's keep that in mind. Yes, numbers are matching. Clear? Yes, yes, good. Let's have that in mind, people. I'm also going to write some imposition for myself to the fact that I have not remembered the standard deduction. Yes, I hope you can also do it if you have made the same mistake. Good, perfect. Let's read further. It says, I have question number 7, which says, Ashima is aged 45 years and has been given the HR manager for the past 15 years in Shipra Limited with the following particulars given to you. So she's been working in a company for the last many years. For the current year, her basic salary is 70,000 per month. The DNS allowance for 24,000 per month, 30% of his farming part. Okay. Bonus is 21,000 per month. Okay. Ashima is contributing 18% of her basic salary to RPF. Her employer is contributing the same amount to her RPF. So she is also contributing, employer is also contributing. People, employer contribution is restricted to 12% of salary, where salary means basic plus DA forming part. Next, company is paying medical insurance premium of 20,000 to the effect of the insurance on the health of Ashima. Company paying medical insurance, fully exempt, not treated as a perk visit. I can outright ignore this off. Has nothing to do with me. Next, she has received an arrears of salary of 3,35,000. Oh, they're going to ask a heavy computation from you people, a very heavy computation which is going to come in. The details of the arrears are given to you. Some data are given of the past. Arrears are received to you in the current year. Question is asking you to compute the relief available under 89 and the tax payable for 25-26, assuming Ashima is exercising the option of shifting out of default tax regime provided under 115 BAC 1A. For assessment at 22, 23 and 24, 25, Ashima has decided to pay tax as per 115 BSc. So they've told you that year she was going for default tax regime. However, for 23, 24, she has decided to go for normal provisions. So which means they're trying to test you on past year data also. The rates of taxes are given to you. Thankfully, at least they've given you the rates of taxes. Nothing should be complicated enough for you. Yes, people, in this, I would not like to do this whole computation because it's going to take a lot of time. It's a good practice question for you. Honestly, if you come and ask me, will never be coming for exam. Yes, these kind of relief kind of questions are taking a lot of time from your exam perspective and therefore will never be tested in exam, people. But just to clarify to you for the current year data. Let's only look at the current year data. In the current year data, what is going to happen? I'm going to take my basic salary of rupees 70,000 per month, which means it is going to be 70,000 into 12. Answer is 8,40,000. Yes, next I'm going to take a DA. Now DA, whether it is forming part or not, people, is always fully taxable. So 24,000 is going to be fully taxable multiplied with 12. Answer is 2,88,000. That gives me bonus. Bonus is a fixed bonus given to me, 21,000 into 12. Answer is 2,52,000. Now comes the problem. I have a PF contribution. How much is the actual contribution I have made as an employer? As an employer, my actual contribution made is what, people? My actual contribution made is going to be 18% of basic salary. So 70,000 into 12 into 18%, which means I have contributed 1,51,200. How much can I claim as an exemption as an employer? Employer's contribution, how much can I claim, people? I can claim 12% of basic pay plus DF forming part. Yes, so let's see what is the DF forming part. 2,88,000 into 30% is forming part plus 8,40,000 is my basic. 9,24,000 is the total salary multiplied with 12%. I can claim an exemption up to 11,08,80. 11,08,80. Let's remove this from this. Answer is going to be 40,320. 40,320 is my total computation. Yes, if I take this into consideration, let's check what the right answer is. 8,40,000 plus 2,88,000 plus 2,52,000 plus 40,320 minus, oh, this is a number. So it's 14,000 20,320. Removing a standard deduction, people. This time I'm not going to forget this. Standard deduction is going to be 1,370,320. 1,370,320. This is going to be a salary computation, but also bear in mind, people, that the question says that the person has done some contribution from his side also to RPF, which means you can now claim an ATC. You can claim an ATC of 1,50,000 from your side. So claim an ATC of 1,50,000 from your side. Number is going to be 12,20,320. 12,20,320. Yes. Now at this stage, 89 relief, people, works in two regimes. What you'll have to do is you'll have to first take this 12,20,320, add the arrears of the current year, and compute the tax as per the normal rules. Then you will ignore this off and take the 12,30,520 and compute tax as per the normal rules. At the same time, what will you do is you'll go to these respective years, and in the respective years you'll take the 9,50,000, 10,90,000, 12,10,000, compute tax as per the regimes they've said. Then add those arrears and then compute tax as per the regimes they've said. Compare wherever you're paying the highest tax. If you're paying highest tax in the current year, you will get a relief. Otherwise, you will get no relief. You'll get no relief. What does all that mean, people? If you read the answers, you'll get the right answer. Yes, so I've taken the same computations. Let's see if my computation and their computation is matching. I've taken 8,40,000. Arrears of salary has been added separately. Given allowance of 2,88,000. Bonus is 2,40,000. Employees contribution is 40,032, which is what we also got. Then we had standard deduction of 50 and employers contribution of 1,50,000 has been taken into consideration, giving them the total income of 15,50,030. I had not taken the arrears, they have taken the arrears. If they remove the arrears, people, 12,20,30 is what we also got. Yes, is the same numbers that we have got. So that is what the computation looks like. So with this, people, what they would have done is they would have taken arrears of salary and they would have computed tax on it, which is 290,169. They would have taken without the arrears, the answer would have been 1,85,649. At the same way, what they've done is they've taken the previous year's data. So 92,560, 70,200, 179,145, 117,995, and they're trying to find out how much tax I would have paid then, how much tax am I paying right now. Yes, so they found out that in the current year, I would have paid an extra tax of 1,04,000, whereas in the past years, I would have only paid a tax of 78,000, and therefore I get a relief of 26,000. I get a relief of 26,000. That relief of 26,000 will be ignored off for the current year, giving you a final tax liability of 264,170. 170. People, this has nothing to do with me teaching you anything. It's all about using your calculator. If you use the regimes properly and you do a calculator computation, you should get all the right answers. This is what is happening. So work with that. Work with that. That is what you're going to keep in mind. Yes, good practice question from a calculator perspective, but rest assured, you will not be getting this for exam. So please don't worry about it. Good. Perfect. With that, people, we are moving on forward to question number 8. Question number 8 is a little lengthy question. Let's see if you're understanding this. It says, I have Mr. K, who's a 48-year-old resident individual. Okay. Some guy with 48 years old. The details of income earned for the previous year 24-25 from diversified business and investment portfolios are given to you. Keeping all that aside, question says, you're required to compute the total income of Mr. K, assuming that he exercises the option of shifting out of default tax regime. Assuming Mr. K's total income excluding minor income is higher than his wife, which means they have now confirmed that he has a wife also and he has a minor child also. Probably clubbing rules are going to apply. At this stage, I have been confirmed that I am going out of default tax regime. I am in ATR. Good. Let's read. It says, I have two businesses, manufacturing business with a profit of 10 lakhs, speculative business with a loss of 7 lakhs. People, I have made a speculative loss. Can I set off my speculative loss against my business profits? No. This is going to be carried forward. This is going to be carried forward for a period of 4 years. For a period of 4 years, because speculative loss can only be set off against speculative profits. Yes, with that, I know my PGBP income has come to 10 lakhs. Has come to 10 lakhs. Next, the person has incurred loss from 2,15,000 from a let out property and has also earned an income of 50,000 from the activity of owning and maintaining horse races. For earning this income, he has incurred an expense of 5,000 rupees. He has incurred an expense of 5,000 rupees. Now, here is where you have to be careful, people. First, they have said from an LOP property, I have 2,15,000. Can I claim the full 2,15,000? Answer is no. When it comes to HP loss, I can maximum claim only 2 lakhs in the current year. The balance 15,000 has to be carried forward. Has to be carried forward. Clear? Second, when it comes to earning the income of 50,000 rupees and incurring an expense of 5,000 rupees, can I set off this expense? Normally, people, a lot of students will come and tell, Rahul, horse race and a winnings only. Can I claim this? Answer is yes. Answer is yes. Understand, that is horse race winnings, meaning that's a casual income. Casual income has a restriction to not claim expenses. Here is the person doing owning and maintaining horse races. He is in an actual activity of owning and maintaining horse races. There is no restriction of claiming expenses, which means you are permitted to claim that as an expense. You are permitted to claim that as an expense, which means the only taxable income I have is 45,000 and not the full 50,000. Be very careful on this, people, because owning and maintaining horse races is a normal activity. It's not a casual income. There you are eligible to claim your expenses. Keep that in mind. Next. He has earned short-term capital gains of 50,000 from equity shares, which are sold on 10th May 2024, on which STT has been paid, which means this now becomes a 111A income. On this, I will take 50,000 worth of income. And as a long-term capital loss of 75,000 from its other assets, which are sold on 15th October. People, 15th October 24 is going to be after 23rd July, but at the end of the day, this is a long-term capital loss. Can you set off long-term capital loss? No. Long-term capital loss can only be set off against long-term capital gains. I don't see a long-term capital gains. This is going to be carried forward for 8 assessment years. It's going to be carried forward for 8 assessment years. Clear? Good. Next, Mr. K took divorce from his wife in April 2024, and the custody of their minor son is given to Mrs. K. People, divorce has taken place, agreement to live apart. The moment an agreement to live apart, no clubbing rules will apply, no deemed ownership will apply, everything goes to the child, everything goes to the parent who's taking care of the child. Question itself comes and says the custody of the child has gone to Mrs. K. With the custody going to Mrs. K, Mr. K is of no relevance here. Mr. K is not going to be taxing any rupee, any money of the child or the wife. Wife is going to take care of the child. Wife will be taxable for the child. Following the divorce, the transferred ownership of house property to his wife, which means he has to give away his property to his wife on account of divorce. Wife is going to be the actual owner. No deemed ownership concepts will apply. During the financial year, the property generated a rental income of 5 lakh rupees, not relevant, taxable for the wife. Taxable for the wife. Next, Mr. K deposits cash of 50,000 every month in the account of his minor son. During the previous year 24-25, this interest income of 25,000 is generated in son's bank account, not taxable for the father. Not taxable for the father. It is taxable for the wife because wife is taking care of the child right now. If wife has the custody of the child, wife is going to be taxable for that income. My question only asks for Mr. K, not for Mrs. K. I don't care. Next, he has also contributed a sum of 2 lakhs to electoral trust and has incurred an expenditure of 30,000 for advertisement in brochure of a political party. Eligible for 80 GGB and GGC. Therefore, I can claim the full 2,30,000 as a deduction. I can claim the full 2,30,000 as a deduction. I should not have any problems here. Yes, good. Next, he authored an investment portfolio book and has received a royalty income of 4,10,000 during the previous year 24-25 from a publisher in Germany. The moment he received an income, people, this is going to be fully taxable. So 4,10,000 worth of income is getting taxed for him. The royalty is calculated 16% of the book value sales. I'm going to see a problem here. Problem is the royalty income is more than 15%. Deduction will get restricted to 15%. The person has incurred an expenditure of 60,000 to earn the income. So under IFOS, I'm going to reduce this expense, which means IFOS income is only 3,50,000. IFOS income is only 3,50,000. Out of this royalty, only 2,90,000 was remitted in India by 31st August and the remaining balance was in abroad till 30th September. Yes, so let's do the computation of 80QQB, people. What is 80QQB computation? 80QQB computation will come and say if 4,10,000 was for 16%, how much was for 15%? So let's find that answer first. 4,10,000 into 15% divided by 16%. Answer is going to be 3,84,375. Now, in this 3,84,375, this person has only received money of 2,90,000 in the current year. So, only 2,90,000 can be treated as my gross revenue. But in this 2,90,000 also, he has ended up claiming an expense of rupees 60,000, which means I can't give that deduction also. Income becoming taxable, income allowing for deduction is 2,30,000. So, this is what I'm going to reduce as 80QQB. as 80 QQB. I hope you understood this, people. We wrote a detailed step in the exam, so in the class also, where I said step number 1, you will restrict it to 15%. Step number 2, restrict it to all the money which is received in India. Step number 3, claim all the expenses which you have already claimed under IFOS. And step number 4, restrict it to the overall limit of 3 lakh rupees under QQB. By that logic, 2,30,000 is the maximum deduction that I can claim, and this is how my incomes will look like. Yes, let's see if the answers are matching with mine. Yes, so we had house property rental. They have treated it as fully ignored because it is taxable for the wife. Next, when it comes to business, 10 lakh rupees of business has become taxable. The speculative loss has been carried forward because it cannot be set off in the current year. HP loss has been set off to the extent of 2 lakhs like we discussed upon. Next, short-term capital gains has been taxed. Long-term capital loss is being carried forward. Royalty income of 3,50,000 like we discussed, and then you have activity of owning and maintaining horse races of 50 plus the 5,000 of expense has been claimed as a deduction, making your income as only 3,95,000. Your ATGGC, which is your electoral trust and political parties, are both claimed as deduction. Oh, they have ignored the GGC for the political party. The advertisement has been ignored of. Okay, that I guess it's ignored of because it's not a company. This is an individual, right? Yeah, this is an individual, people. That's why it's not claimable deduction. My bad. So it's not 2,30,000. It is only 2 lakhs which you can claim as deduction. And then your 80 QQB has come in for the 2,30,000, the same thing which we discussed of. Yes. So the restrictions of everything has been taken into consideration. You have arrived at 2,30,000 as a computation. What is the restriction? We said, people, restrict to 15%, bring it to 2,90,000 because that is what was received. Remove the 60,000, which is what has been expensed off in the IFOS, giving your income as 2,30,000. That is what the computation looks like. Clear? Yes, fairly an easy question, but yes, definitely had some tricky adjustments that you have to keep in mind. So be very careful on that as a question of. Good. Good. That brings me to question number 9, which talks about your TDS. Let's look at the question. It says, ABC Limited, having its registered office in Noida, has agreed and organized an annual company function at its Gurgaon office. For this purpose, the company has engaged Beta Private Limited to arrange road transport for its employees from Noida to Gurgaon and back for a payment of 25,000 rupees to be made. ABC Limited has also entered into a separate contract for providing catering services at the function for rupees 90,000. People, both the sections are under 194C. Both the sections are around 194C, where it comes and says 194C, where it says 194C comes and says that if you're going to enter into any kind of contract with another person, the single payment should exceed 30,000, or if not, the consolidated payment should exceed 1 lakh rupees. If any of the two conditions are satisfied, then I will be deducting TDS at the rate of 1% if the other person is an individual or HUF, or 2% if the other person is a non-individual or HUF. Here is a transaction where I've engaged Beta Private Limited to arrange for two things. One, for a transportation, which is 25,000 and therefore is less than 30,000. But when I engaged him for another contract for 90,000 rupees, the overall money in the current year became 1,05,000. The moment it became 1,05,000, it crossed the overall yearly limit of 1 lakh rupee, and therefore this 1,05,000 is liable for TDS at the rate of 2%. At the rate of 2%. I hope you understand this. Yes, so it is 30,000 per payment, whereas it is 1 lakh for the full year. The moment you cross the 1 lakh rupees for the full year, you were liable for TDS. Good. Second one, it says, I have Vijay Health Solutions, third-party administrator, making payment to various hospitals towards settling cashless medical insurance claims on the behalf of the insurance company. During the financial year, the total payment made is 12 lakh rupees. People, this is a TPA case. 194J rules come into picture for the purpose of taking TPA rules, but yes, there are some rules to be kept in mind. Let's read the rules together, people. I hope you understand the rules along with me. It says, where the payment is by a TPA was made on behalf of insurance companies for settlement on account of services rendered. These services are primarily medical services and therefore are applicable for the section of 194J. In the present case, Vijay Health Solutions is required to deduct TDS at the rate of 194J, and therefore it will be at the rate of 10%. Like I said, 194J rules will apply, and therefore you can deduct TDS at the rate of 10%. This was an easy question. If you are reading TDS, most of the students would be choosing to ignore TDS, but if you have done that, then yes, nothing of consequence. Otherwise, you should know easy questions. 194J would come at the rate of 10% here. Clear? Yes, amazing. That leads me to the last question, people, the total income, the compulsory question for your exams. Let's see what kind of adjustments ICA has given here. Last question. It says, Vaibhav is a resident individual aged 46 years. I am a normal citizen, engaged in the business of plywood and sculptures, maintaining his books of accounts under 44 AP. Person is also maintaining his books of accounts. He follows the mercantile system of accounting and is regularly filing his return. Goodbye, no problem. Profit and loss for the year ended 31st March has shown a net profit of 51,42,000. They have already crossed the 50 lakh limit. Surcharge applies after debiting and crediting the following items. During the year, Vaibhav has taken professional services from a lawyer in relation to a service dispute. The legal fees was 1 lakh rupees. Tax was deducted on time but did not deposit it with the government on the due date. TDS was later deposited on November 15th, 2025. People, 40A IA comes into picture. 40A IA comes and says, if you have defaulted in paying your TDS on time, then disallowance of 30% will be triggered for resident payments and 100% will be triggered for a non-resident payments if you do not pay the TDS by the due date of return filing. This case is a payment to a lawyer. Nothing has been mentioned. Always assume resident, which means I am going to make a disallowance of rupees 30,000. I'm going to make a disallowance of rupees 30,000. Very good. Second, Vaibhav has renovated his office by engaging in the services of his brother as the existing premises has become very old and required refurbishment. The total payment for the renovation amounted to 2,50,000, whereas a reasonable payment would have only been 1,50,000. People, section 40A2. Related party transactions, you cannot make a payment more than what is allowed in the market. My brother is going to be a related party to me, and therefore I should have made payment as per whatever the market says. So I have paid a money of 2,50,000, whereas I should have paid 1,50,000. I will disallow 1 lakh rupees here. I will disallow 1 lakh rupees here. Now, people, I have a single doubt. Question says the person has renovated his office. Yes. Now, renovation of office can have two assumptions. Assumption number one is that renovation of office can also mean a capital expenditure. So, if you make the assumption that this is a capital expenditure, then probably the whole 2,50,000 is disallowable. You don't have to disallow the balance 1 lakh alone. You'll have to disallow the whole 2,50,000 because technically that's a capitalized cost. Yes. Right now, I don't have a right answer. I'm assuming that this is not going to increase my future economic benefits. So, I'm assuming this to be a revenue expenditure, and therefore I'm only disallowing the 1 lakh rupees, which is the unreasonable payment. We'll have to check what is the right answer. Next, he has purchased goods worth 30,000 from Vishnu & Co, a micro enterprise, on 1st March 2025. According to the return agreement between them, the payment was to be made by 5th April 2025. Let's check for 45 days, 31 here and 31 plus 5, 36 days. Yes, it's happening. However, the payment has been made to Vishnu on 15th April. People, you have defaulted on your promise. When it's a micro and a small enterprise, defaulting on your promise will not be allowed as a deduction. You can only claim it in the year in which the actual payment is made, which means in the current year, I will have to disallow this expense. Now, I would also like to clarify this to a lot of students. A lot of students have made this misconception. Misconception is people say, even though I have defaulted on my promise, if I make the payment within 45 days, I will get the claim. The answer is no. It is 45 days or your promise date, whichever is earlier, which means the moment you defaulted on your promise date, it was denied as a deduction to you. I cannot give it to you just because you paid within 45 days. That's not how it works. Be careful there. Next, depreciation as per P&L is 13,66,000, which has to be fully disallowed. Next, as per the restructuring agreement with the bank has converted unpaid interest of 6 lakh rupees into a new loan repayable in 20 equal annual installments. The first installment was paid in March 2025. Vaibhav claimed the entire amount of 6 lakh rupees as an expense while computing his business income. People, 43B, very common adjustment I've told about, that when you have taken your interest and you've converted into loan, income tax is not going to give you this deduction until you repay the loan. You're not going to be given a deduction until you repay the loan. You cannot claim this deduction, which means, first of all, the fact that the question says they have claimed the entire amount of 6 lakh rupees as an expense, I am going to deny that, which means 6 lakhs is going to be denied as a deduction. However, now I can claim all my expenses which I've paid off. If you notice, question says 6 lakh rupees is the total loan interest amount which has been divided over 20 installments, which means first installment is 30,000 rupees, and they have said that the first installment has been paid, which means I can claim my first installment of rupees 30,000. I can claim my first installment of rupees 30,000. Are we making sense? Yes, good. Next, depreciation as per income tax rules is 12 lakhs, which means now I don't have a problem because the question itself has come and confirmed what is my depreciation amount. I can claim the number as is. I don't have to worry about the renovation expenses and ignore it off. Next, I have contributed 50,000 towards tier 1 account of NPS during the year. I have also invested in 5 years term deposit of 1.5 lakhs. People, contribution of 50,000 towards tier 1 account of NPS is 80 CCD. 80 CCD is what is going to come into picture. Have I opted for old regime? Yes, I've opted for old regime. If I'm opting for old regime people, this is allowed as a deduction under 80 CCD. 80 CCD, I can claim a flat 50,000 rupees, no restrictions whatsoever. No restrictions whatsoever. When it comes to your tire scene, that is 80C, therefore full 1,50,000 again allowed as deduction. People, for those who remember, we discussed about it, that when it comes to 80C, triple C and CCD, only the 10% of employees that has a restriction of 1,50,000. A separate 50,000 is anyway eligible for deduction, so that can anyway be claimed as a deduction. I don't see a problem there. So you can claim the 50 and the 1,50,000, both are eligible. Next, I have a 90 new employees. Oh, 80CCA is coming in. Let's check. I have 90 new employees coming in. People, what is my business line? I'm in the business of plywoods and sculptures, which means I'm not for 150 days, I'm here for 240 days. Looking at the 240 days, first one says 21st April, regular 24,000. Yes, perfectly eligible, no restrictions. 25, 1st May, casual employees. Casual employees are not participating in RPF, which means not allowed for deduction. Next, 30 August. August is still eligible, but 26,000 has been given. More than 25,000 not eligible. And fourth one, 15 September. September, October, November, December, Jan, Feb and March totally becomes 7 months. 7 months into 30 becomes 210 days. I have violated the 240 days condition, therefore not eligible. Nevertheless, they have anyway given it's a casual employee. Yes, so I'm only going to be eligible for the first bucket. The first bucket is going to be 24,000 multiplied with 20 employees multiplied with 12 months over 30%. Answer is 17,28,000. Answer is 17,28,000. Yes, great. Next, Mr. Vaibhav had sculptures in the form of capital assets acquired in Jan 2025 for 1,80,000. In 23-24, he started a sculpture business and therefore had converted this capital assets into stock in trade. In that year, he had some assets. Current year, it has become stock in trade. Fair market value of the conversion was 3,50,000. Okay, so that year I would have done some capital gains computation. Subsequently, he sold the stock in trade on 5 lakh rupees in June 2024. No entry has been made in the books for the conversion or the sale of the converted sculptures. I have missed out even my capital gains and my PGBP. People, here is where we'll have to do the composite split. If you remember, I discussed this with you. In a composite split, what we're going to do, we're going to compute CG separately and we're going to compute PGBP separately. Tell me what is my full value of consideration. For my CG, my full value of consideration is the transfer value. Transfer value becomes 3,50,000. At the same time, this becomes my cost of expense for my PGBP. In the current year, I have sold these assets for a price of rupees 5 lakhs. So which means I'm going to sell for a price of rupees 5 lakhs. How much did I purchase them from? I purchased there for 1,80,000. Yes, so I ended up purchasing this for 1,80,000. Now here is where the catch point is. Here is where the catch point is. People, you will see that the conversion took place on, the sale happened on June 10, which is before 23rd July. So therefore, you are eligible for indexation benefits on the capital gains. And the one mistake which students will end up making is they may end up claiming the indexation up to 363, which is wrong. Understand, conversion took place in that year of 23-24, which means you have to take indexation only up to this period. So this is the actual period up to which you can claim your indexation. You can't claim any indexation for the current year. Yes, we discussed it when we discussed conversion of capital asset into stock in trade. Conversion of capital asset into stock in trade clarifies that you will convert it on the date on which the capital gains, you will compute your capital gains on the date on which the conversion took place. You are simply paying the tax in the current year. So tax alone is being paid in the current year. Conversion took place in that year itself. Yes, but at the same time, yeah, that is what is going to happen. So I'm going to keep that in mind. So it is 1,80,000 to be multiplied with 348. To be multiplied with 348 and to be divided by 240. 240. Help me out here. So it is going to be 1,80,000 multiplied with 348 divided by 240. My computation is 2,61,000, which means my capital gains is going to be how much? My capital gains is going to be 89,000, whereas my PGBP income is going to be 2,50,000. No, 1,50,000. My PGBP income is going to be 1,50,000. Yes. Now people, conversion of capital asset into stock in trade rule comes and says that even though capital gains is taxable in 23-24, it will be deferred off until the stock in trade is sold, because the stock in trade is sold in the current year. The capital gains also is going to become taxable in the current year, which means I will add both these incomes to my computation in the current year. The 89,000 will be taxable as CG, long-term capital gains. You can claim tax at the rate of 112 at the rate of 20%. At the rate of 20%, whereas the 1,50,000 will be taxable as your PGBP income. Will be taxable as your PGBP income. That is what the facts are going to be. Yes, this is how the questions are. Let's see if the computation matches with mine. So see, I have a net profit of 5142, which is what I also declared to you. So 5142 is what we're going to have. Then depreciation has been disallowed. Professional tax has been disallowed for 30% because the TDS was not done on time. Next, 1 lakh was disallowed because of renovation expense. Like I said, right, we have made an assumption that this is not going to increase my future economic benefits. 30,000 has been fully disallowed for micro enterprise, even though it is within 45 days. Promise has been violated. Next, conversion of assets, full 5,70,000 is disallowed. We did right, people. 6 lakhs we fully disallowed. 30,000 we claimed as deduction. Next, your payment for stock in trade 1,50,000 has been added. Like I said, PGBP computation, add 1,50,000. Depreciation was claimed of 12 lakh rupees. Sale consideration was decided of 3,50,000 the conversion date versus 2,61,000. Like I said, indexation is only given up to the date of conversion, and therefore they've identified the income is taxable for 89,000 to be taxable in the current year, because current year is the date on which the asset has been sold. With that, people, they have claimed an 1,50,000 of ATC and 50,000 of NPS, like we said, and then an 80JJA of 17,28,000. Matching everywhere. Income has become 43,49,000. Luckily, people, even though my net profit was 51 lakhs, my total income is only 43 lakhs, which is less than 50 lakhs, which means when I start computing my taxes, I will not take into consideration surcharge. So what they have done, my LTCG has become 20%. My balance income of 4260 has been gone for normal tax income, which is 10,95,000. I have simply added my cess and I got my tax liability. Clear? Yes. Now, people, what you missed and you did not do properly is the fact that I have something called as 80JJA here. Here, and if you remember this properly, when we go to your income tax computation, there is something called AMT rules. AMT rules basically come and say that if you have claimed any of the three components being your 35AD, component number 2 being your 10AA, and component number 3 being your heading C of chapter 6A, which is nothing but JJA, QQB and RRB. It's nothing but 80JJA, QQB and RRB. You should compute your AMT rules if your adjusted total income crosses your 20 lakh rupees. If you notice here, my total income has been 43,49,000, which means I have crossed 20 lakh rupees. And the moment I say I have crossed 20 lakh rupees, I am supposed to compute AMT rules. Look how beautifully they have done that they've taken their income of 43,49,000 and they've added up 80JJA to get an income of 60 lakhs. Because the income became 60 lakhs, 18.5% of your AMT rules applied. 10% surcharge got applied because 60 lakhs is my total income now, and therefore they got a tax liability of 12,86,140. Yes, with your AMT becoming 12,86,140, you are actually supposed to pay tax as per AMT rules and not as per normal rules. Such beautiful adjustments, so tricky and so thoughtful that most of the students would have missed it out for your exam purposes. Yes, having the fact that you have 80JJA itself means that you should have computed for your AMT rules, and they did not do that. If you don't end up doing that, people, your tax liability, you would have reported 11,52,000, which is actually wrong. It's actually wrong. You should have reported 12,86,140. But yes, because you're paying taxes for AMT rules, you can carry forward AMT credit. AMT credit has been taken as 133,510 to be carried forward for 15 years. I would strongly suggest to mark this one as important, because you would have missed this out. You would have not taken this into consideration. Yes, please be bearing in mind that the moment you see three incomes, and we have been telling this so many times in their classes, that when you see three incomes, which is 35AD, 10AA, JJA, QQB, RRB, you should definitely check for AMT no matter what. Yes, you may never know that the AMT would be the challenge which you're going to have for your exam. So be very, very careful on using this AMT rules. This has been tested off. Yes, be very careful on this, because that is what they have prepared off and that is how they have completed the computation of. Yes, That is how the RPT looks like, people. If you come and ask me on an overall level, I will say every question was really nice. Every question was really nice, except for that 89. I didn't like that relief under 89. Too lengthy, too complicated, too unnecessary things for you. So I would not suggest you to focus on the 89. But every other question was really interesting because everything was from the past. You have done all these things. You have really understood all these things from an exam point. But sometimes you just end up missing those. RPT always helps you realize those things. So I would strongly suggest that if you have gone through the RPT properly and if you realize that there are some places which I have not been able to use my head properly, please don't leave it as it is. Go back to your notes, make markings of those adjustments and tell yourself that, you know what, this is the marking which I did not realize when I was doing my RPT. I will promise myself that I will do it when I do my exams, and you will do it. You will do it. Trust me, people, to lose something is not wrong. To not recover back from it is the mistake, right? So please take those notes and make sure that you don't make those mistakes when you go for your Jan exams. And I'm pretty sure that is how your exams will go. You will do extremely well and so nicely for your exams. That is the kind of confidence I have on all of you. Yes. So for the next 2 months, my small request, please continue your preparations as much as possible. Take this next 2 months as a challenge for yourself to tell yourself that this is the last time I'm writing CA Inter. I'm not going to be waiting anymore and I will complete my exams to that extent. And I'm sure by the time your January exams gets over and your February comes, you will already have something called as a CA finalist tag showing in front of you. Yes, with that note, people, I would like to leave you for today. I hope you all have a great learning time. If you have any challenges, any doubts, my number is given in the description box. Please WhatsApp me and I will be happy to assist you in any kind of queries you have. Take care. Happy learning. Bye-bye.